This time, XRP is to blame for the crypto world's recent frenzy. Millions of XRP tokens have been secretly transferred into markets by some of the largest institutions in the world. At first impression, this appears frightening. Why would banks dump such large quantities of a promising digital product? The reality, however, is far more nuanced. This orchestrated dump may be one of the best indications ever for XRP's price to rise, according to our study and on-chain data. Prices may occasionally rise to $500,000 per token, which is something that is unimaginable to the majority of professionals. On-chain monitoring technologies have detected anomalous activity in bank-controlled wallets. These wallets, which are connected to reputable banks and their businesses, have been selling XRP in a fairly systematic manner over the last few weeks. The sheer volume is astounding. In well-planned segments, millions of XRP were distributed to various marketplaces worldwide. Selling for fun isn't the only goal here. It makes sense. The transactions are not natural shopping because they are too organized, too precise, and too centralized. Experts say that rather than being panic or distress selling, this trend appears to be a deliberate attempt to boost liquidity. The true narrative of these changes revolves on time and the government's intended regulatory framework. These sales are a step toward widespread regulatory approval, according to people close to Ripple and several large institutions. The price of XRP will fluctuate significantly as a result of the influx of fresh institutional capital. By selling now at reduced prices, banks are essentially clearing out their stock to ensure that their balance sheets are prepared for a cash rush following approval. They are capable of doing this. They intend to repurchase XRP at increased prices, following the market's reaction to public backing from governmental or regulatory entities. In a criminal sense, this is not manipulation. It's a carefully considered strategy to maximize the company's gains and reduce its hazards. To grasp what this means, historical analogies are required. Consider the trajectory of Bitcoin in 2017 prior to its sharp ascent to nearly $20,000. Much Bitcoin entered the market as a result of the notorious MUTC dump. Individual investors in a panic sold at reduced costs as early adopters and astute institutions covertly accumulated. The market roared back up as soon as the dust settled. XRP appears to be following suit. With the same fundamental reasoning, the bank's current behavior is uncannily similar to that period. Pay off debt today to gain control later. Thus, the supply dynamics are crucial to our research. A significant portion of XRP tokens are held by banks, and the total amount that can be produced is restricted. When they cautiously sell off parts, causing a brief increase in market supply, individual investors are strongly motivated to sell as a result of the short-term downward pressure this produces. However, unless institutions intervene and purchase the excess tokens in predetermined quantities, there is a shortage of liquidity after the move is authorized. There is a significant gap between supply and demand as a result, which may cause an unprecedented bull run. According to analysts who have been considering this scenario, if XRP gains traction as the primary asset that international banks use for settlement, the price of each token may rise through the roof. In the case of long-term institutional adoption, the numbers can reach $500,000. The psychological component is equally significant. Fear and uncertainty frequently influence people's thoughts. These bank actions are already being misreported by the media as panic sales, which is untrue. Although this story increases market volatility in the short term, institutions ultimately benefit from it. Banks generate opportunities for themselves to acquire by inciting short-term anxiety, while individual investors sell their shares at prices below their current value. Value. When positive government news is released after this cycle is over, it allows prices to rise sharply. By coordinating price resets with impending adoption festivities, the banks are deftly manipulating public sentiment. It all comes down to time. According to our sources, banks are preparing these actions in advance since they anticipate several legislative changes. Some of these are anticipated recommendations that clarify XRP's legal position in important markets, approve its use in cross-border settlement networks, and encourage major institutions in Asia, Europe, and North America to institutionalize it. When people's perceptions of how dangerous XRP is will change as a result of these events being legally acknowledged, and demand will soar as both large and small investors scramble to participate. The brief price declines now appear to be purely strategic in nature. From a technical perspective, The charts indicate some odd patterns. Exchanges saw significant surges in volume with no change in prices. This means that the selling pressure is absorbed or balanced out in real time, arranged by buy-side liquidity management. This is not how panic-driven store dumping generally works. It's like sophisticated institutional trading where there are a lot of trades. They occur at separate times and prices aren't affected too much. When circumstances are favorable, this ultimately positions the market for a significant gain. It doesn't indicate extreme weakness. It's useful that it resembles the early institutional accumulation of Bitcoin. Similar to how Bitcoin's historic run was triggered by Mt. Gox's closure, XRP's recent bank dumping may portend the largest wealth transfer in cryptocurrency history. Now that the pattern is visible, people may be able to get before broad acceptance picks up momentum. Conversely, those that panic sell during these deliberate dumps run the danger of losing the entire bull market. It's a scathing irony. In reality, a negative sign is a prearranged setup for a massive positive outcome. The tale is further supported by the ongoing efforts by Ripple to get major banks and other financial institutions to join the platform. Leaked investor presentations, partnership announcements, and internal communications all suggest that, once rules are clear, XRP will be the common bridge currency for international cross-border transfers. These prices are rising at an unprecedented rate due to a combination of institutional demand and the bank's strategy to sell off assets and then buy them back. Models that consider worldwide utilization, transaction velocity, and total liquidity absorption offer theoretical targets in the high six-figure range. These are still only estimates, though. Another item that intensifies the effect is burning or permanently removing XRP coins from circulation. The supply would be further reduced if certain institutions decided to sell some of their holdings after receiving clearance. This could result in an even greater price explosion as usage picks up speed, especially when paired with the bank's intention to temporarily close. Because of how the supply is managed, the restrictions are clear, and institutions are purchasing cryptocurrency. This scenario differs from others that are optimistic. The news's portrayal of anxiety or distress is ultimately a well-planned build-up to XRP's next massive bull run. Banks are intentionally, not inadvertently, dumping. Before regulations change, they are selling their stock and preparing to repurchase it at significantly higher prices. This is comparable to the cryptocurrency market, has previously been successful, creates the conditions for significant long-term growth, and makes the maximum money for institutions by taking advantage of shifts in supply. For purchasers who know how the market operates, the current situation is a once-in-a-lifetime opportunity. When properly integrated into the institutional landscape, XRP has the potential to transform the way people use digital assets to generate income and achieve previously unthinkable objectives. That might occur in the worst-case scenario. The maximum value of each token might be $500,000. It's simple to comprehend. Don't be the land